Okay, we'll get started now. So hello and thank you to everyone for attending this webinar. We're going to discuss we're going to spend the next hour or so together where we discuss the removal of special purpose financial statements for certain for-profit private sector entities and the introduction of the Simplified disclosure standard. So this is the second webinar in the series. So welcome to those of you that joined us last time. And also welcome to those of you that are joining us for the first time. My name's Kim Carney. I'm on the staff of the AASB and I'm pleased to be joined by Carmen Ridley today. For those of you that may not be aware, Carmen is a recently retired AASB board member. So we're very fortunate to have Carmen working with us, with the AASB staff on some certain projects, one of which is this series of webinars. Before we get started, just a little bit of housekeeping. As with all our presentations, any views expressed today are our own views and may not necessarily be shared by the Australian Accounting Standards Board. Okay, and I guess by way of background, so in early 2020, the AASB removed the ability for certain for-profit private sector entities to prepare special purpose financial statements. And at the same time, they also introduced the Simplified disclosure standard, a disclosure standard which replaces the existing reduced disclosure requirements regime. During the first webinar, Carmen gave us an overview of the high-level overview of the changes, including who was affected by the new requirements, what the affected entities need to do. And Carmen also explained what happens if an entity can continue to prepare special purpose financial statements. For those of you that missed it, I know there were some issues last time. So for those of you that missed it, a recording is available on the AASB YouTube channel. If you missed it and you didn't receive a link to the recording for some reason. Now, during this particular webinar, we're going to go through and discuss the transitional relief that's available. We're going to break it up into three main sections. So we'll cover those entities transitioning from RDR, those entities transitioning from special purpose that have previously complied with recognition and measurement and consolidation and equity accounting, and those transitioning from special purpose that did not comply with recognition and measurement and consol and equity accounting. Now, the plan is that we'll pause at various points during the session to allow you to ask any questions. The best way to ask your questions is by typing them into the Q&A function, and we'll certainly attempt to answer as many questions as possible. My understanding is that if you're on a computer, the Q&A function is in the taskbar at the bottom of your screen. And if you're on a mobile, you should be able to click on the screen to get the option to type into the Q&A function. Again, if technology permits, we plan to include a recording of today's session on the AASB YouTube channel, and you should also be receiving a copy of the presentation slides after the session as well. Now, before we get started on the detail, we have a quick polling question just to better understand who we have in the session today. So I'm going to launch that question. Give you a few seconds to answer, please. You can see that most of you have answered, so we'll just give a couple more seconds. Fantastic. So similar to the last webinar, actually, we've got a good mix. So mostly preparers with some auditors, some other professional services staff, and also some attendees fitting into the other bucket. So it's pleasing to see that, yeah, we've got a nice mix in the room today. At this point, I will now hand over to Carmen, who will take us through the rest of the content. Thanks, Carmen.
Thanks, Kim. Welcome, everyone. As Kim mentioned in the last webinar, we spent lots of time talking about the who and the what was happening. This webinar, we're really going to go through how you actually do it and some really key decisions that you will need to make. Before we get into that detail, it's really important that we understand the effective date. So I said last time that it was effective for annual reporting periods beginning on or after 1st of July 2021. Just to make it really clear, I've put on the slide which year ends that actually is. So it's your 30 June 22, June year ends will go first, 30 September 22, 31 December 22, and then 31 March 23. Some of you may have year ends that don't fit in there. I tried to include the most common ones. So this is the year end that we're talking about when this becomes mandatory. This is the drop dead date if you are impacted by this standard. The reason it's so important that we've got our head around these dates is there are some incentives for early adoption, and that's what we're going to spend a bit of time talking about today. So we've got the mandatory dates. Any date prior to this is early adoption. So if we take a June year end, early adoption would be adopting it at 30 June 21. Scarily, we are in the middle of May, so 30 June 21 is creeping up very, very quickly. So if we move on to start looking at the different type of entities. First one we're going to start with is actually the only one that we're going to cover today that applies to both your for-profits and not-for-profits. I know in webinar 1, I spent a lot of time saying that this change was not really an impact for the not-for-profits unless they were doing RDR. So remember, RDR impacts the not-for-profits and the for-profits. So what we're looking at here is an entity who is currently preparing Tier 2 general purpose financial statements, RDR. So full recognition and measurement, full consolidation, full equity accounting. It's just they take advantage of that shading that's included in the accounting standards, which is our reduced disclosure. So these entities have an impact because, as Kim mentioned, we are removing RDR and we are introducing the simplified disclosure standards, so AASB 1060. So let's have a look at the impact for these entities. AASB 1060 is a standalone standard. This is a slide that I included in the last webinar just for completeness. So we've still got all of the recognition and measurement requirements from each of the individual standards, but the presentation and disclosure are all within 1060. So that shading that we've been used to for the last few years, which is our RDR standards, that will no longer exist. If we are doing Tier 2 general purpose financial statements, we're using AASB 1060 as simplified standard. Now the move doesn't affect the numbers because you're going from one tier of general purpose to another tier of general purpose. The numbers are identical. Talked in the last session about there are some additional disclosures, but in most areas there is a reduction, and I've got them at a very high level at a later slide. There is some work to just do some figuring out your disclosures compared to the SDS, but we will talk through that process. So if we move on to the next one. So the process that I've come up with for how to do this, you're starting with your RDR accounts. So the ones that you've been doing for the last few years, we are knocking out any disclosures that are no longer required by AASB 1060. We're adding in the extra disclosures that will be required by 1060. And that's what gives us our Tier 2 simplified disclosure general purpose. Now that's the process if you want to work through it and just have the minimum level of disclosures that 1060 requires. Because 1060 is just minimum disclosures, you can always go above that. So in that second step where I say that you can take out the disclosures no longer required, you choose to keep them in. That's fine because 1060 is only minimum and you've gone above that. You will always have to put in the extra disclosures required by 1060, things like your imputation credits, things like your audit fees. But if you want to reduce the amount of work on day one, you could miss out that second step. The only thing I would say to you, however, is it might take some more time on day one to take out those disclosures and really make sure that what you've got in there is what's needed. If you choose not to, going forward, you've got extra disclosures that you have to prepare each year and extra disclosures that have to be audited. So while you might save time now, it might actually be a little bit more costly and timely going forward. So that's an option that you have to do. Purely disclosure change, no change at all to recognition and measurement, just to keep reiterating that. So if we move on. I didn't want to spend this session going through every single disclosure change and the difference between RDR and SDS, because it would have been very boring for everybody and it would have taken all of the time. So what I've done is I've just pulled it up from a topic perspective. So you can see on the left-hand side of the slide, we've got disclosures that are not required by the Simplified Disclosure Standard, but were required by RDR. So you'll be knocking those out. On the right-hand side, we've got disclosures that are required by Simplified Disclosure that were not required by RDR. Now, those of you paying attention closely will notice that there are some things in both columns. And that's because under the RDR, it was based on full IFRS. So therefore, there may have been some things in the full IFRS that aren't required by SDS. Under the Simplified Disclosure, it's based on IFRS for SMEs. So it could be slightly different wordings, so that one disclosure is not required, but another disclosure in, for example, hedging may be. So it's not that we've got it wrong by putting it in both columns, it's just the disclosures are slightly different. We do have a key facts document on the AASB website, so the 1060 key facts document that goes into these in a little bit more detail and actually explains in each of those topics what the differences are. So when you're working through this process, you've got that understanding. For many of you who are listening, things like hedging probably isn't applicable anyway, so we can knock many of those off. In the employee benefits, some of those changes are around defined benefit plans. Again, you may not have some of those. So let's look at the transition relief. Now, as we've already talked about, your numbers don't change if you are already doing RDR and moving to SDS. So therefore, you're not going to get some huge transition relief because there's no numerical changes. But the board did want to give you some assistance. So what the board decided is that if you choose to early adopt, and this is coming back to that mandatory date that we've talked about. So if you early adopt, you are adopting at 30 June 21 up to 30 June 22. So if you choose to early adopt, let's take the new disclosures, for example, the audit fees. Last year under RDR, you were not required to disclose audit fees. So your 30 June 2020 financial statements did not include audit fees. At 30 June 21, we do require you to disclose what the audit fees you paid were. This relief says if you early adopt, you don't need to show that disclosure under the comparative year. So you only need to show it for 30 June 21. Going forward, you've obviously got that information, it'll be in there. So it's just to try and save you going back, trying to recreate disclosures from the prior year that you were not required to do then. Excuse me, that is only available if you early adopt. If you choose not to early adopt and you adopt on the mandatory date, so for again, my June year end, that's 30 June 2022. There is no transition relief available. You will show your audit fees for 30 June 21 and 30 June 22. So that's the relief available if you are moving from RDR to SDS.
So Carmen, I'll just interrupt if I can, just before
Yep.
to the next session. We've got a couple of questions coming through. Are you happy to answer them now?
Yes.
Yeah, perfect. Okay. So the first question is just in relation to a previous slide. So on this particular slide, you've written primary financial statements. So just asking, what does that mean, please?
So there are some that are required, some of the disclosures. Off the top of my head, I haven't got the list in front of me. Off the top of my head, I can't remember, but under simplified disclosure, you can actually get rid of the statement of changes in equity. So you do have the ability to get rid of that statement and present, I always get the name wrong, I think it's a statement of income, expenses and retained earnings. You can do that instead of your statement of changes in equity. So it quite possibly is that one, but I have a feeling there's a little minor comment as well in relation to that. So we can under SDS present 3 statements only if certain conditions are met. It's not everybody who can get rid of the statement of changes in equity, but many of you whose only change will be result for the year will be able to lose that statement.
Okay, thanks, Carmen. And we've got another question. So this is in relation to a not-for-profit entity that's currently preparing RDR accounts. Yep. And I know that we've talked through a couple of reasons why they might want to early adopt in terms of the relief from presenting comparative or re-presenting comparative information and things like that. This question is just whether you think they should early adopt at 30 June 2021.
My personal view is yes, I do, because I think that you can actually go through, I think you would knock a lot of disclosures out, and I think it's much easier to actually work out the required disclosures under 1060. I've compiled disclosures checklists in the past on RDR, and they're not necessarily easy to do because part of sentences are shaded and it's not necessarily always easy to work out which disclosures are in or not. So I think 1060 is such a much easier document. I would be moving to it as quick as I could. Can I give you a huge incentive to? Not particularly. It will take some work to actually knock out some of those disclosures that aren't needed, but I think you will get a more meaningful set of financial statements.
Yeah, thanks, Carmen. That's all the questions for now.
All right, fantastic. So that's our RDR moving through to the simplified disclosure. What we're now going to look at, so we're going to work up through the difficulty levels. So that was the easiest one because you're already doing general purpose, you're just moving the disclosures. The next one is you were previously preparing special purpose financial statements. Your numbers fully complied with accounting standards. That means that you said you did recognition and measurement, you said you did consolidation, and you said you did equity accounting. So effectively, you had exactly the same numbers as if you were doing general purpose. It might be that you just chose to do special purpose because you believe that there was no users. One of the common reasons could be, for example, that related party disclosure isn't needed for special purpose, but otherwise you wanted the numbers right. Now, this is where we're moving on. It is only going to be for-profit entities that are no longer able to do special purpose financial statements. So we've moved away from the not-for-profit now. Nothing else I'm going to talk about, except possibly in some questions, relate to the not-for-profits. Everything else is for for-profits only. So an entity that's numbers are correct. We are moving on to our Tier 2 simplified disclosure. So it's purely the only change will be disclosure change. We're moving into 1060, making the assumption with this webinar, like we did with the last one, that anybody who is moving is going to move to Tier 2. You're not moving up to Tier 1. So this is why all I'm talking about is moving to the simplified disclosure and AASB 1060. So let's move on to the process for these particular entities. I can have the next slide, please, Kim. So when I've come up with the process here, it's quite similar to moving from my RDR to simplified disclosure. However, I've worded it slightly different because I think the quality, if I can use that word, of the financial statements under RDR, which were general purpose, compared to the quality and the level of disclosures under special purpose is probably a bit different. So the first thing that you need to think about is what disclosures have you currently got in the special purpose financial statements? And that varies significantly. I review a fair number of financial statements. Some of them are really substantial and you look and you go, pretty much they're always already at general purpose. Other times I pretty much just get primary statements and maybe some accounting policies, so quite different. So the first thing is we have to understand what disclosures are currently there. The second thing we'd have to do is understand which disclosures are required by 1060. Now, 1060 is set out, as we mentioned last time, into sections. So if you want to know which disclosures are relevant for property, plant and equipment, for example, you would just go to that section. And that section has all of the disclosures that you need. So work out which are your significant transactions and balances, look at the relevant sections to understand which disclosures are going to be required by each of the sections. Then we compare. We've got existing disclosures. We know what disclosures we should have. What's the difference? I don't imagine with special purpose that you will have many disclosures that are in excess of what you will need under 1060. There may be some. So for example, if you are complying with all the disclosure requirements of 108, there is a requirement in 108 to disclose standards issued, not yet effective. That's not required under AASB 1060. So that one would come out. But I suspect generally you're going to have more disclosures rather than less disclosures. So the next thing that you will have to do is, once you've identified those differences between what we've actually got and what we should have, you prepare the extra disclosures. Numbers don't change, remember, we are just preparing some extra disclosures. Take that step back, review your financial statements, make sure that you've got everything in there, that you're telling the appropriate story of the significant transactions that have occurred within the business. The outcome from that is your Tier 2 Simplified Disclosure General Purpose Financial Statements. So that's the process where you do comply with all recognition, measurement, consolidation, and equity accounting. This slide, pretty much identical to the slide from the RDR. So what I've done, the way we've structured this particular webinar is you pick the section that's relevant to you, and hopefully it should be complete. Hopefully all of that information is in there for you. So that's why we have repeated some of the slides, just to make sure it's complete for you. So as we talked about with RDR, if there are extra disclosures that you need to include, probably more so for this one than RDR, you are not required to provide comparative information for those disclosures if you early adopt 1060. If you do not early adopt 1060, if you choose to adopt it on the mandatory effective date, there is no transition relief. It's the same as what we've already talked about for RDR. So because the numbers don't change, the only disclosures, transition relief rather, is in relation to disclosures. Hi, Kim.
Sorry, we've just got a couple of questions. So
yep.
Now would be a good time.
Yep.
So one of the questions is just in relation to, I guess, compliance with Australian accounting standards and the numbers in the financial statements being correct. So the question is whether an entity is required to comply with all Australian accounting standards so that the numbers are correct. I think this is getting at whether it's, whether you can selectively apply recognition and measurement, or whether it's all transactions.
Okay, so let's assume that's the question, and we might get the person to type something else in if that's not actually the question. So when I'm saying that you've complied with it and all the numbers are correct, yes, it is all relevant accounting standards that you've complied with. If you say all we've complied with is property, plant and equipment, that doesn't count, because your numbers will change, because when you move to general purpose, you will have to comply with all recognition and measurement requirements in the standard that are relevant to you. If you don't have biological assets and you haven't complied with the biological asset standard, that's fine, because it's not relevant to you. So we're talking about all standards that are relevant to your balances and transactions.
Thank you. And just another question, I guess, to quickly clarify. So if we've got a for-profit entity and they're not affected by 2020-2,
yep.
So the question is, are they still able to use the term special purpose financial statements?
It's a really interesting question. I've had this quite a lot. I'm happy for your thoughts as well on this, Kim. I guess the board didn't really specify in any of the standards whether you could or couldn't. My view is, why would you need to? Can you just call them financial statements and actually just specify in the basis of preparation what you're complying with? Because if you're not having to do general purpose, effectively you can prepare the financials on whatever basis you want. And we gave some examples of that last time. So the term special purpose doesn't actually mean anything. The most important thing is tell me in the basis of preparation what you actually do. Is it cash accounting? Is it modified accrual? Is it we comply with some standards? So there's nothing stopping you, I don't believe, use the term special purpose financial statements, but the biggest issue is making sure it's absolutely clear how they've actually been prepared.
Thank you. Those are the only questions we've got for now.
All right, fantastic. Let's move on to the next section, and we might start getting lots more questions on this one. So again, for-profit entities only. I'm just re-emphasizing that again, because for-profits are the only entities who are being required to move to general purpose. So what we've talked about so far is where you're currently doing RDR, or you're currently complying with all recognition, measurement, consolidation, and equity accounting. So the only thing that's changing is your disclosures. This area that we're going to talk about is where you are not currently complying with all relevant recognition, measurement, consolidation, or equity accounting. There has been lots of questions in the past about, is consolidation recognition and measurement, and can I say I'm complying with all recognition and measurement if I haven't done consolidation? That conversation's not relevant for this. We're telling you that if you have not complied with consolidation, you're in this section, regardless of if you believe you've complied with everything else. So here is where we either haven't complied with all recognition and measurement, we haven't complied with consolidation when we should have done, or we haven't done equity accounting when we should have done. So forget what any guides that might be out there about whether recognition and measurement is, or consolidation is recognition and measurement. This is what we're focused on here. So if you haven't complied with one of those, you're in this section. Obviously, we're talking about where you have to move to general purpose. We've just had that question about if you can continue doing special purpose accounts, or you're not having to do general purpose. It's not relevant here. These are only the entities who have to move to general purpose. So let's see what the impact is for these guys. Again, this is a slide that I just pulled from webinar 1, so I'm not going to talk through it, because in webinar 1, we really did spend some time looking at how we got from our not complying to complying. So it's working out what the numerical changes are going to be based on current accounting policies compared to what the standards require, and then those disclosure deficiencies. So we get around and end up with an opening balance sheet. Now, what we're going to spend the rest of the time looking at is that opening balance sheet, that transition. When do we adopt? When do we not adopt? This section is where the entities are going to change their numbers. This is not purely disclosure. This is where we will see numerical changes. And therefore, we've got the most work in this area, because we're not just preparing a few extra disclosures that we can grab from a set of model accounts. We are actually having to recalculate things. The first thing we need to think about is how are we going to get there? So we talk about the opening balance sheet. Now, when we're thinking about our opening balance sheet, this will depend on whether we choose to early adopt or whether we don't choose to early adopt. The opening balance sheet will be the first time we apply these particular standards. Now, those of us who've been around and can remember back in 2005, 2006, when we transitioned to IFRS, will remember there was this little weird standard called AASB 1. We've ignored it for the past 15 years. It's now back again. It's back in our lives. So we have a choice. The way that we get from not complying to complying is using one of these two approaches. AASB 108 is the standard that deals with accounting policies, change in accounting estimates and errors. And it's the standard that we've always been used to whenever we had to change an accounting policy, either voluntarily or we changed it due to an accounting standard. And what that standard says is for any change in accounting policy, you apply the new policy as if it's always been in play. So let's assume that I have got a balance sheet, a June year end, and my opening balance sheet is 1st of July 2020. At 1st of July 2020, I apply all of the standards as if I always have done. Now, if you've got transactions that kind of have been around forever and there's been changes in standards, it's as if you've been doing that the whole time. It's actually probably a fairly complex approach to do, which is why back in 2005, AASB 1 was a standard we all used. So AASB 108 is apply all the policies as if you have been applying them from day dot on the particular transactions and balances we're looking at. The disclosures require us to disclose each line by line item, what the changes were. Again, those of you can remember back in 2005, we had some fairly detailed transition disclosures. What were the transition differences on the opening balance sheet, transitions on comparatives, etc. So that's what we call the normal approach that we use when we change the standards. What the board have done is the board have specifically addressed going back through AASB 1. Now, if you aren't complying with recognition and measurement consolidation and equity accounting, that means that you weren't saying your financial statements were in accordance with Australian accounting standards. Hence, AASB 1 is the standard that gets you from not complying to complying. So AASB 1, the overall approach is similar in that at the opening balance sheet, we apply all the policies that have been in play. However, it gives a number of mandatory and voluntary exemptions that are included. So for example, there are certain things that it does not want you to restate. Probably not an issue, probably not going to affect too many people. The more interesting area is that there are certain things that you are allowed not to restate. So some of the common ones that I think may be of interest is for business combinations. You have a choice on how you deal with business combinations in the financials. You can either restate them all from day dot. Given that AASB 3 has changed a few times, however, at one point we used to capitalize acquisition costs and then we didn't. That could be quite challenging. You can choose a particular date, and you can say I'm restating all business combinations after that date, but not before that date, or you can do it at your opening balance sheet date. There's the option to deem fair value to be cost at the opening balance sheet date. And I know back in 2005, there was a lot of entities who were very excited about doing that. It's a one-off opportunity to get from the fair value model back to the deemed cost model. So there's a few different options within that particular standard that provide you with a lot more flexibility. You can see which one I'm really suggesting you go down from the way that I'm speaking about this. So AASB 108 is really adopt everything as though it's always been in play. AASB 1 is similar, but gives you much more flexibility and gives you some more choices about how you will restate your financial statements, which particular balances. There is certain relief to make life a little bit easier. If life can be made a little bit easier in some areas, absolutely, let's take that easy option. From a disclosure perspective, there are also less disclosures. What you are required to do is provide an equity reconciliation at the date of transition. So if you can imagine your retained earnings, what we're asking you to do is effectively reconcile the movements in retained earnings on adoption of all of the recognition and measurement requirements within the standard. You'll notice in each of those two columns, I've got a AASB 1060 reference. So depending on which one you choose, there is different guidance within 1060 about the disclosures that you are required to do. So the 108 approach is just the general section on changing accounting policies, changing estimates, errors, etc. And the AASB 1 approach is a specific first-time adoption relief of some of the standards. So where your numbers are going to change, you have to make a decision about which of these two standards you are going to follow. How are you going to get your opening balance sheet to be in compliance with recognition, measurement, consolidation, and equity accounting? So it's a first accounting policy choice that you will need to make. So having made that decision on how are we going to get to the opening balance sheet, let's now look at what our opening balance sheet looks like. And this is where we're going to diverge a little bit. So this whole section is about if you are not complying with recognition, measurement, consolidation, and equity accounting. But now I'm diverging about when I adopt. If we choose to adopt this standard, so you are going to be required to move to general purpose, you can choose to move there early or not. If we choose to adopt this on the mandatory effective date, remember we've talked about that back on those earlier slides, you are going to be required to do the financial statements at the date you adopt this standard using what's called the full retrospective approach, which means that we restate comparatives. So again, I'm using a June year end. My 30 June 22 financial statements will be the first year that I do general purpose financials. My 30 June 21 will be restated. So even though I've already done last year's accounts and I issued them, I prepared them, I got them audited and they're published, if I choose to adopt this standard on the mandatory effective date, I will be required to completely restate those numbers in accordance with recognition, measurement, consolidation, and equity accounting, which means my opening balance sheet date is the 1st of July 2020. So I put all of the changes through on that date, whether I'm adopting the AASB 1 or whether I adopt AASB 108 approach. When I look at these financials, I've got an apples versus apples comparison. The whole lot is in accordance with the recognition, measurement, consolidation, and equity accounting elements of the standard. So bear in mind that if you choose this, that 30 June 21 will need to be prepared again and will need to be audited again. So there is extra work that is required in doing that particular approach. Let's look at what transition relief is available for you. Now, if you choose to adopt this on the mandatory effective date, the relief that is available to you is that there is no need to distinguish if you find an error in your accounts compared to if it's a change in accounting policy. And the reason that the board did this is because they really thought, we want to get the numbers right. We don't need to be spending the time saying how much of it is an error and why did the error occur compared to how much of it is a change in accounting policy. So hence the reason that this particular relief was provided. And to illustrate what this means, I've got an example for you. So my financial statements have previously said they complied with the recognition and measurement requirements of AASB 16. We haven't said we comply with anything else. We've just said we comply with AASB 116. However, during the course of the analysis that we've talked about earlier, where we were going through, we were looking at the differences, we realized that actually we didn't completely comply. There was depreciation that we undercharged of $100,000 in prior years. Had we really been complying with the standards properly, we would have had depreciation, which was $100,000 higher. As part of that process as well, we worked out that in order to comply with the employee benefit standard and to comply with the deferred tax standard, we were going to have to put some other adjustments through, and those adjustments came in total to $106,500. Rather than having to say 100,000 was an error and 106,500 was a change in accounting policy, what this relief allows you to do is just to call them all changes in accounting policies. So if we look at what that might look like in the financial statements, you can see that in my reconciliation of retained earnings, I've got my opening retained earnings of whatever it is, and then I call it change in accounting policy and transition to general purpose, and I've just got the three different elements. So I don't say that the depreciation was an error, I just lump them all the same way. It's not changing the fact that you have to adjust it. The adjustment still has to go through. It's purely just changing the disclosure requirements around it to avoid you actually having to work out how much of all your changes are errors and how much of them are changes in accounting policy. So that's where we adopt it on the mandatory date. The other alternative is we early adopt. So if we early adopt, we've got two transition reliefs that we are making available to you. So again, I'm using a June year end. If the mandatory date was 30 June 22, the early adoption date is 30 June 21, 6 weeks time or just over 6 weeks time. Last time when I adopted on the mandatory date, I told you that we used full retrospective and I had to completely restate my numbers for last year. If I choose to early adopt, I've got my 30 June 21 numbers that will be in full compliance with recognition, measurement, consolidation, and equity accounting. My 30 June 20 numbers are just whatever I included in last year's accounts. I do not restate them. I don't adjust them. I don't do anything with them, except put a little asterisk next to them and point out that they were prepared in accordance with the special purpose framework, and therefore the comparability will be reduced. So the difference here is all I have to do is one column in accordance with my recognition, measurement, consolidation, and equity accounting. My opening balance sheet date is 1st of July 2020, and that's the initial adoption date in AASB 1. AASB 1 assumes you're going to go back and restate. If we early adopt and we don't restate, that's my opening balance sheet date, 1st of July 20. Those of you who are paying attention to the dates I'm saying would realize that 1st of July 20 in my two scenarios is the opening balance sheet. Regardless of whether I adopt or do not early adopt, that's my opening balance sheet date. That's the date that all my adjustments go through. The difference in this one is all I'm doing is 1 year's worth of changes. So if, for example, I had to adopt consolidation, if I didn't early adopt, I'm redoing an extra consolidation for the prior year. If I do early adopt, I just leave last year's accounts. That column there, that 30 June 20, could be a single entity financials, and 30 June 21 is my consolidated numbers. So we accept that there is probably not a lot of comparability here, depending on how much recognition, measurement, consolidation, and equity accounting you did apply. But it gets us to where we want to be 1 year quicker. It actually gets our numbers being in full compliance with the accounting standards at 30 June 21 rather than at 30 June 20. So that's my first transition relief if I choose to early adopt. The next one, the next two slides are identical to the transition relief that I've just talked about. You're also being given this relief where you are not required to distinguish between errors and change in accounting policies. So exactly the same example here. I'm not going to talk through it again. As I mentioned, the way that we've structured these slides is that you can pick the section that is relevant to you and work through that. So rather than you had to jump around in other bits, we wanted to actually put everything together. So if you early adopt, you get the benefit of not restating comparatives. You also get the benefit of not distinguishing your errors from your changes in accounting policies. So you can see that table again, exactly the same table that we have just talked through. So just to reiterate, if you are not currently complying with recognition, measurement, consolidation, and equity accounting, and therefore your numbers are going to change when you move to general purpose, the relief that is available to you varies on whether you early adopt or whether you don't early adopt. We talk about an incentive for early adoption, and this is it that we've just talked about, that non-restatement of comparatives. So you are saving yourself time, effort, and money from not restating prior year numbers.
Thanks, Carmen. As predicted, we've got quite a few questions.
I could see out the corner of my eye, lots of things flashing up.
Yeah, no, there's quite a few questions. So the first question is just confirming whether or not the changes apply regardless of a company's turnover. So obviously there's grandfathering and things like that in place. But the question is just whether there's, I guess, a de minimis threshold. So for example, if turnover is less than $1 million, are they out of scope, or do these requirements apply to anyone that's in scope?
So I guess the short answer is watch webinar 1. I'll give you a little bit of a longer answer. So it's all about whether you are required to move to general purpose. So it is not that every for-profit entity has to now do general purpose. There were the 2 requirements. One is that you had a legislative requirement to prepare financial statements in accordance with Australian accounting standards or accounting standards. The second one is that there was a non-legislative requirement to prepare financial statements in accordance with Australian accounting standards, and that depended on the date of that document. So go back and listen to webinar 1. So I guess it talked about less than $1 million. Let's assume they're a for-profit, large proprietary, they wouldn't have to be doing special general purpose accounts because there's no legislative requirement to do that, but make sure that you understand the criteria.
Thank you. There's a couple of similar questions. So there's another one here. If an entity is currently doing special purpose, can they continue to do so? So again, we've shared the link. Yeah, it depends. We've shared the link to webinar 1. So that's a good place to start.
Yeah, and it's just those 2 criteria. If they meet those 2 criteria, you have to do general purpose, or one of the 2 criteria, you have to do general purpose. If not, you can continue to do your special.
Okay, thank you. So we've got a question here, and this is for entities that are transitioning from special purpose to tier 2 at the mandatory date and that are using AASB 1, can we just confirm if they're required to present the 3rd balance sheet?
So I've just read the rest of that question. My understanding is that no, they weren't required to do that, but there is a comment in there that it looks like that it's a bit inconsistent. So my understanding is the answer is no, but we will just check your references to those paragraphs and just check that that makes sense. Kim, is that your understanding under 1 when we're just doing the yeah. So that statement, that equity reconciliation is all that's required.
So we'll check that line and come back to you. The next question we've got, so special purpose allowed the use of accelerated tax rates against equipment depreciation. And so the question is, whether there's an effect on this effect as a result of this on general purpose. Is there a need to reverse accelerated depreciation or anything like that? It sounds like a disconnect between tax requirements and accounting requirements and things like that.
So I'll caveat it with I know nothing about tax. We'll caveat that first of all. Special purpose financial statements, you could generally do what you wanted if you weren't complying with accounting standards. Under general purpose financials, if you're required to do that, you will be depreciating the assets over their estimated useful life, either via straight line basis, a reducing balance basis, or units of production. So if by that, and I'm going to put an assumption in here, let's assume that what it meant was that you could fully write off an asset under tax purposes. You can't do that for accounting purposes. So under your general purpose financials, you would be depreciating over the asset's useful life, assuming it was above your capitalization threshold and assuming it was material.
And so if an entity early adopts and they've not previously consolidated, what will the 2020 comparatives look like?
So can I get you just to go back 2 slides, I think, please, Kate? No, go forward again. Keep going. I can't keep going. Next one, that one. So, oh, yep. So this one here, which I think is the question, if we're early adopting, we're not consolidating previously, what will the comparatives look like? That 30 June 20 column will be single entity. You are not required to restate it. So you will have single entity, and then the 30 June 21 will be consolidated. My asterisks there is to refer to the fact, as you can see underneath, that it's prepared under a special purpose framework and does not comply with all Australian accounting standards. You will then describe in the financials what that change has been, and that will include we didn't consolidate and now we do. So you won't have comparability on that balance sheet, but you will have the 30 June 21 numbers being in full compliance with Australian accounting standards.
Thank you. We've got a question in a similar vein. So because the comparative information will be unconsolidated and the current year will be consolidated, there's a comment that it will look a little bit silly and there might be some effects on comparability. So the question is just, I guess, how this is a good outcome or why the board went down this path.
Yep. And I've had quite a few people have asked this kind of over since this standard was released. And I guess if I go back, the board initially wanted this standard and these outcomes being in compliance with Australian accounting standards sooner rather than later. And when the effective date was moved out, and we discussed this option about not restating comparatives, the board decided that if we use the bigger picture and we meant that we got these numbers right 1 year early, even though we did lose that comparability, it was a better outcome. The reason that we thought this was appropriate is we also looked at what the International Board had done in regard to revenue and leases. So they have allowed non-restatement of comparatives for both of those major new standards. The world didn't fall apart, and therefore we thought for this 1 year, it's probably a better outcome to get the 30 June 21 numbers right rather than waiting for that extra year. So agree that you will lose the comparability, but we still think overall as a bigger picture, it's a much better outcome.
And so we've got a situation here where an entity has previously been preparing special purpose and they've lodged them with ASIC. They are a large proprietary company, but they've relied on one of the ASIC class orders for audit relief. So the question is, I guess, whether there's any change from these proposals to that audit relief and the ASIC class order.
Okay, so if we have relied on a class order and that class order, so we'd say here it's just a relief of audit, there will be no change. As far as we know, the AASB is not involved with class orders. As far as we know, ASIC will not be changing any class orders to do with audit relief. This is about the type of financial statements that need to be prepared, nothing to do with audit.
Thank you. So another question just in relation to, I guess, the requirement for entities to restate.
Yep.
And this is a question that's possibly more coming from an audit perspective, but just in relation to, this is potentially for some entities going to be a significant undertaking. So how much, if any, assistance can the auditor provide in terms of clients having to restate and things like that?
So I guess this comes back to general independence rules, and we can't audit the work that we've just helped prepare. So you would really struggle, same as when we transition to IFRS. Advice could be given on the type of general accounting policies and the areas where changes need to be made, but no, the auditor cannot work and come up with the numbers because then they're auditing their own work, which is not permitted. Probably a good time to remind everybody that I think, Kim, 2 weeks' time, we do have a third webinar, which is going to be really focused on auditing impact. So Kim and I will be there, but predominantly the session will be run by the AASB to talk specifically through some audit issues. So the auditors listening, please make sure you've got that in your diary.
Thank you. Another question, I guess, just confirming if we're choosing to early adopt restatement, reclassification of comparative information. We've covered it a few times, but just to make sure that everyone's crystal clear.
Yep, so it's good that we've still got this slide on. So if you choose to early adopt, you are not required to, or you can choose, still always restate if you want to, but you can choose not to restate comparative information. So that comparative column in my picture on the slide, the 30 June 20, is exactly what was reported in prior year accounts. You literally grab the numbers and you pop them in, roll them forward from last year's accounts. You do not adjust them, you do not change them. All of the adjustments to moving to general purpose will be put through on the 1st of July 2020. So you do not change those comparative figures.
Thanks, Carmen. We've got a question here, and I just turned my camera off for a second because I was madly trying to find my accounting standards handbook to give you some more information, and I failed miserably. We've got a question here just in relation to the business combination exemption. So this is in AASB 1, and the specific paragraph reference is C4J. And the person's just asking for some more information. Now, it's quite a specific question, so it might be something that's best taken offline. But if you had any initial
I do have
thoughts.
my standards book in front of me, so I'm just very quickly looking and see if I can answer it. So I guess that's in the voluntary. So that specific paragraph, I'm probably not going to comment on specifically, but I just to raise that business combinations, there is a significant number of options here about not restating certain elements of that and about how much you do restate it for. So that one in particular talks about where you haven't consolidated in a past business combination and now you have to. That paragraph needs to be read in conjunction with that whole appendix. So that whole appendix is on about how you treat business combinations under AASB 1 and the different choices that are available to you. So it's probably a bigger question than that one paragraph. Happy if there's a specific example that comes through, but probably talking about that one paragraph in extension to what I've already talked about with the business combinations probably doesn't make a lot of sense to most people.
Thank you. We haven't, we've just got, we haven't got any more questions coming through at the moment. Is there any other final things that you wanted to share with us?
I guess what I think, and I talk to lots of people about this, and there still is a huge, I guess, lack of understanding about who is captured and who isn't captured. So some of the questions that we've had indicate that there's still some confusion around that. I would really strongly suggest go back and listen to that first webinar. The first thing you need to do before you get caught up into some of the detail in this session is to really understand who is impacted and who is not impacted. Because what worries me is that I think there is still some entities who think that everybody has to move to general purpose, and I don't want you spending time and effort when really you might not be captured at all. So please make sure, if those of you who are preparers really understand your situation, those of you who are advisors or auditors, please make sure you understand your client's situation, which clients are impacted, which clients aren't. Remember, not-for-profits are not required to move to general purpose. So if you've got not-for-profits, you're out immediately. The only impact for not-for-profits is our RDR entities who will have to move. So it's really just keeping going back to basics and keep listening and getting your knowledge up on this.
Thank you. We've got just a couple of additional questions. So this one's just in a few sentences. Can you just give us a simple summary of who is affected, please?
Yep. So there's two criteria. So it's a for-profit entity who is impacted. If you are required by legislation to prepare financial statements in accordance with Australian accounting standards. So the example is Corporations Act. If you are required to report under the Corporations Act, you are going to have to prepare general purpose accounts. Now, whilst we always give the Corporations Act as an example, that's not exhaustive. There are lots of other legislations, just the easiest one, the one that most people can relate to. So there's a legislative requirement to prepare financial statements in accordance with Australian accounting standards. Or, and that's an or, it's not an and, or there is another document that you are required to comply with. It could be a trust deed, it could be a constitution, it could be a bank agreement that requires you to prepare financial statements in accordance with Australian accounting standards. There's some other issues around that about the date. So depending on the date that document was created or amended, there's some exceptions for that. And again, we cover that in more detail in webinar 1, but at a high level, it's where there's a document that requires you to comply with Australian accounting standards.
Thank you. Just got a question. So we've had quite a few questions today on the restatement of comparative information and things like that, where entities are early adopting. So we've spoken about if you early adopt, the comparative information isn't restated. And so the question here is, changes going through retained earnings, and they're just not quite sure how that would actually work.
Because you would do retained earnings as at the beginning of the current period. So you would do it at the 1st of July 2020. So comparatives wouldn't change. Can you go back to that picture, Kim? And that might be an easier... That one, yeah. So your comparatives don't change. So 30 June 20 stays the same. The day after 30, or the second after 30 June 20, so one second past midnight on the 1st of July 20 is when you put all those changes through. So that's where retained earnings changes, because at that date, everything has to comply with recognition, measurement, consolidation, and equity accounting.
And this question is specific to not-for-profit entities. So the question is whether they still need to apply the reporting entity concept. So if they're no longer a reporting entity, for example, would they then need to move to general purpose?
Okay, yes, they still need to apply the reporting entity concept. It hasn't been removed for not-for-profits. So if you are non-reporting, you can do special purpose. If you are reporting, you will have to do general purpose.
Thank you. And we've got time for probably one more question, Carmen. So if an entity is not affected by AASB 2020-2 and presumably is therefore still preparing special purpose, the question, I guess, is just confirming whether they can still pick and choose which accounting standards they would like to comply with in their financial statements.
Yeah, again, we covered that in webinar 1 about what could happen if you could still do special purpose. And it really comes down to, if there's nothing requiring you to comply with standards, you can choose what you want to do. You can do cash accounting if that's what your users demand. You can do modified accruals. The real key is make it clear what you are actually doing. So if I read your financial statements, can I understand the basis that you have prepared these under?
Thank you. So we've 1 minute to spare. We'll just move through the last couple of slides. So I'd like to thank everyone for their attendance and participation at today's session. Thank you also to you, Carmen, for your insights and explanations. As mentioned a couple of times, this is the second in a series of webinars. So the next one will be held on the 25th of May. And as Carmen mentioned, that will be looking at audit impacts and considerations, or things for auditors to consider. Carmen mentioned also that there's some key facts documents that might be helpful. So there's a couple of those on the AASB website, and there's also a bulletin on the AASB website which covers some of the matters for auditors to consider, which could be quite helpful in preparation for the pending transition. Again, just like to thank you all for your time. I've included Carmen's contact details and my contact details on this final slide. We will send a copy of the slides and hopefully a link to the recording shortly after this session. As always, if there's any questions, comments, concerns or feedback, please feel free to get in touch with us. There's a couple of questions that we haven't been able to get to during the session, so we'll come back to you offline. And on that note, again, thanks very much to everyone for your time and participation, and I will now close the webinar.